Okay, good day, everybody. This is Jim Kinney for the weekly update for OptionProfessor.com. And a quick background on myself. I'm a graduate of Boston College. And for those who haven't been listening, I have been in the investment arena here for decades, educating people on the uses of risks of options, doing hundreds of seminars for thousands of people nationwide. And basically, today, what I'm going to be doing is going over my views, my opinions on what I see out there in a wide variety of markets. Hopefully, give you some insight and some help on figuring out what's going on. As always, I do tell you that it is a situation where past performance is not necessarily indicative of future results, and of course, short-term trading and option trading do involve substantial risk of loss. So you got to consult your trading advisor. You've got to consult your clearing firm, the guy you're doing your buys and sells through, and also your good common sense to figure out what, if any, tactics of any type might be suitable for you. Okay. Now, again, the date today is the 21st of December, 2018, 4 days before Christmas, and the markets have been under pressure. If you've been listening to my broadcast weekly, I've been bringing that to your attention ever since we started breaking down. I also brought to your attention that a move under 2,600 on the S&P. We saw a long-term moving average that I use that has been broken a couple of times in the last 10 years, once in 2011 and a couple of times around 2015, 2016. In each incident, we went about 200 points underneath the moving average. So that's why I came up with the 2,400 neighborhood on the S&P where this thing could peter out. So keep an eye on that 2,400 area. That could be an area where things have gotten back in line. Abby Joseph Cohen has been speaking, and although she says she's not obviously indicating to buy right now or this month or whatever, she is indicating that the overvaluation of stocks has been removed in large part, and that the valuations down here are much more reasonable. And of course, reasonable valuations and against fundamentals is very important. Okay, now let's take a quick look at what's going on with the indexes, and I'll work around the investment arena and give you some different views on each thing. Okay, the S&P 500. Let's get the chart up there. I'm sharing it with you now, so please take a look. All right, you can see the S&P 500 is the low today is 2434. So again, we're getting into that region around 2400, right? No, there's no exact science to it, so it's a neighborhood, not an exact price. But this is certainly a neighborhood between here and 2400 where the market may stabilize. Some of the major stocks have gone down significantly. The VIX hit 30 yesterday. That's a good sign. The higher the VIX goes, the closer we are to capitulation. Now, with regards to the low on the move down, it was happening today. So we made a new low for the year, 52-week low here today, but it did snap up 20 points. It's at 24.55. Again, once this market started breaking under 2,900 and once it started breaking under 2,800, you could see that it was in a deteriorating fashion. What I suggest to people to investigate when the market is up and might be rolling over, to look at the collar strategy in the options arena and married puts. Had you done that when we were up at 2,900, you'd be happier today. And it involves the selling of a call and a buying of a put. And if you don't understand the strategy, I'm more than happy to explain it to you. Simply shoot me an email at optionprofessor@gmail.com. And I'll be more than happy to respond. Give me your contact information. We can even talk over the telephone. And I'll try to give you more clarity on how hedging strategies work. Believe me, hedging is a very good place to be when the market falls apart like it is now, because your equity is stable as opposed to tanking. And of course, married puts cost money. So, of course, if you're wrong and the market rises, you do lose the put premium. But in this environment, those puts have been gold. Now, that's what I'm trying to give you an idea on here as far as the S&P. This 2,400 area, plus or minus a little bit, may very well be an area where stability comes back into the market. Looking at some of the major stocks, I'll give you another one here. Apple, which many of you own. As I said, the market was rolling over after it broke under the 220, 210 area. And you can see right there, after it broke under 210, it's been a very significant down move. I thought that it might stop at 190. It did for a day. Once it broke under 190, you got another sell signal. And then I thought it might stop at 180. And then, of course, it did stop and ran back up above 180. But after it came back under 180, you got another sell signal there. And now we were trying to test that 150, which I told you would be a target if we kept going down. So this 150 area, which is the 52-week low, is right now in play, and you certainly would like to see it stop. But the PE ratio down at 12 is a heck of a lot better than it was at 223 or 230, right? So that's where Abby Joseph Cohen's coming in, where the PE ratios are dropping substantially. And if Powell is right that the economy is not falling off the bed, that these are getting to be cheaper stocks. And that's where the 2,400 lows might be. And that's where a little bit of a year-end rally may come from. The year-end rally is running out of time, but if this market stabilizes this week and gets some kind of reason to move back up, obviously a lot of people have liquidated, and obviously a lot of people are going short. And that does create an environment where buyers could come in, and the sellers, if they dry up, you could have an outnumbering order imbalance of buyers against sellers. Obviously, on the way down, it's been an order imbalance of sellers over the buyers. But things don't go in one direction forever, as you found out when it rolled over in September, October, right? So again, it has had a very big move down, $80 off the price. Again, only so much punishment is deserved if they're, one of the reasons is they're not going to tell you the sales of the iPhones every time. I think they've already punished the stock pretty good. So, you want to be bearish, 230 is a good place to get bearish. You want to be bearish down at 150, that might not be Phi Beta Kappa. And again, some strategies to consider if you're a put trader, if you're an option trader, selling puts. They're probably pretty fat down here. You can go out of the money, get paid a fat premium. If you get put to stock, you got to buy it. If you don't get put to stock, you keep the premium. If in fact you want to take the premium and buy a call with it, that's another tactic. If you don't understand all this stuff, I certainly do. So again, shoot me an email. I'm more than happy to give you some insight on these things. Okay, let's look at some of the other indicators that I watch. The transports and the Russell. They led us on the way up. They led us on the way down. Let's see how they're doing now. Okay, the transports are very close to their 52-week low. They went to 89.49 today, as you can see, and the low is 41. So far it hasn't taken it out, but it's hanging on by the skin of its teeth. It's currently at 9,005. Like I say, when we started taking off earlier this year to the high point, that was in the July-August timeframe. It was a leader on the upside. Once it hit 11.5 and started to roll over, then what do you got? You got it underneath 11,000. That was the time for the sell signal. That's the resistance. Came down sharply, rallied back up to 11. Look, couldn't get above the resistance. See those lows in August? That was your resistance. You see the breakdown in October? That's your resistance. Couldn't get above it, went right into the tank. Obviously, it's getting into an overdone condition down here, possibly, although you'd like to see the volume spike up to get a real accurate low. There could be one more big flush because the VIX, we'll get into that right now, has not really exploded on the upside. And you'd like to see that, ideally, the VIX explode to the upside to call it a capitulation. Right now, the VIX has hit 29. You can see it hit 30 yesterday. That's not really a capitulation, but it is a stretch point. Beautiful would be below the 35.40, then you real tradable low and a real identifiable low. And then, of course, getting back above 2,600 on the S&P would be quite important. A lot of you guys own the tech stocks, so let's take a look at the NASDAQ and see what's going on in old comp. The NASDAQ is 64, again, made a new week low today, 63.64 on the NASDAQ. Obviously, the stocks that were trading at high PE multiples had gotten smashed. And of course, a lot of the fluff is coming out of this thing big time. Where'd you get your sell signal here? That's called a double top, right? Right there's a double top right above 8,000. Okay. And once it got underneath that point right there, which is about 7,900, that was your sell signal. And again, 7,600 was support. So on the way back up, you see it can't get above 76. Okay, so this thing's on the defensive. But if you want to get bearish on the NASDAQ, you get bearish at 8,200. You want to get bearish at 6,400? God bless you. So again, there could be very large put premiums out there on some of the stocks you might like. If you sell a put, you're agreeing to buy the stock. Or if you don't get put stock, you get to keep the premium. Okay? So the thing is what? This is the time to investigate that side of the trade to see if it makes any sense. Again, if you have had high PE stocks, they've lost their PE ratios. That's why they're getting whacked more on a percentage basis than the other stocks, because the fluff has been taken out. They're normalizing interest rates. So that means they're going to be normalizing PE ratios. That means they're going to be normalizing the returns you generally get in stock. That's the facts of life. You want to fight the tape, you're going to lose a lot of money. So the bottom line is where we are right now. Start investigating the puts and see how big the premiums are if you like the market for a rebound. Again, you're catching a falling knife right now, so that's a dangerous thing to do. But my mathematics says somewhere around this 2,400 S&P could very well be a low point. So if we could get a nice big spike up in the VIX and we get down towards 2,400 plus or minus a bit, that could be the neighborhood where I would suggest you start looking at the long side. Okay. All right. Now let's take a look at the bond market. Okay. The bond market. Okay, TNX, that's your 10-year note. Still hanging around. You see that tail? That tail might be telling you that the rates are going back up. So that tail comes in at around 27.5, right? Okay, now we're at about 279 on the yield. Now, Powell believes the economy is still strong. I believe the economy is still strong. 3.7% unemployment. Everybody's running around spending money. That doesn't sound like a time for a collapse, right? All you've really done in the stock market is you took out the overvaluations and you normalizing the PEs, and you're going to normalize the rate of returns. And we are getting to a stretch point possibly on stocks. Again, we're at a stretch point here. Got very overbought. The whole world was short the bond market. Why? Because the whole world knew rates were going to go up, right? Well, when the whole world knows anything, you got to worry about who's on the other side. In other words, when everybody was shorting these bonds, somebody was buying them or shorting these notes, right? And the moving averages don't lie. The moving averages on this particular instrument was way up on the futures in the 122, 124 area, and the futures went down 117, 119. That's oversold. And now we've come back up, and now we're not oversold because we've come back down here to the 280, 270 area. Okay, but the fundamentals are that wages are growing at 3% or better. Fed funds is around 2%. That is not a great relationship. And the prices index, because capacity is going at 60, that's a high number, and the tariffs are going to possibly make these companies raise their prices to offset the tariffs. So I think there's going to be price inflation surprise, and I think there's a wage inflation surprise, and so I'm still a believer rates are going back up. If you're in fixed income and you've been holding bonds, obviously you got whacked very hard, and now they're giving you some of your money back. I personally would suggest that you look into keeping your maturities or your duration short, 1 year, 2 year, in that window. That's where you get most of the yield. You get 265 on a 1 year. You get about 2.5 on a 6 month. You go out 10 years, you're only getting 279. So why wouldn't you keep it short until you have some evidence that rates are really going to go low? And I don't think that evidence is here yet. So if you're a fixed income person, my belief is not to extend your duration too far just yet. Wait for more evidence that 325 area on the 10-year is going to hold. And again, if there is an inflation surprise, which I anticipate, then that would be a situation where these rates would go back up. And the Fed is looking for 1 or 2 more hikes possibly, and that is data dependent. What you can't have happen if you're managing the Fed is you cannot have inflation on wages and prices going higher substantially than your Fed funds rate, or else you can have some real problems. Jay Powell knows that because he has been in these markets for a long time, and he's not managing interest rates so that stock speculators and real estate speculators can make a ton of money. He's doing it to have good employment, stable inflation, and a stable currency. That's his job. His job is not to try to get Amazon to 2,500. His job is not to get your house to add another 200 grand on it. That's not his job. And so when you get over valuations and things normalize, obviously prices can pull back. That's exactly what's happening right now. Okay. All right. Now, the US dollar. Let's take a look. My belief is that it's topping out in the 98 area. You see that 98 area? I think it's topping out there. I could be wrong, right? But if we get under 96, that's going to be a yellow flag, or that's going to be a red flag. And is it possible that the dollar could roll over big time? Yes, it is, particularly if he's slow on what? He's slow on raising interest rates. And I'm correct that the inflation numbers may kick in. I mean, I'm not, setting up my whole life that if the inflation numbers don't kick in, I'm going to be ruined. But I am respecting the idea that wages, when you're at 3.7% unemployment, wages can start getting heavy. And with all these taxes credits that they got, and all they're doing is buying back their own stock, there's going to be a little bit of a groundswell to share some of that tax savings with the employees at some point, right? And then also, again, people are going to demand more wage because why? Because there's going to be a tight labor market. And if you want to keep your employees, you got to pay them. So that's going to happen there, I think, on the wage front because of the low unemployment. And I think you're also going to see pass through on this China tariff thing because I think Trump is going to be stubborn. And I think China can see we're deteriorating. So what's the rush? Plus, maybe Trump only got 24 months to go. So why make a deal with somebody who's not going to be there in 24 months? China is thinking in terms of decades, not 24 months. Okay. So having said that, there is vulnerability possibly to the dollar if we break under 96 and then 94. And if that in fact happens, okay, then you're going to be looking at the possibility of gold having a much better environment because gold does thrive when inflation picks up above the interest rates. If you were there back in the early 80s when it went on that huge run, that was because inflation got way above the what? In the interest rate. And again, the GDX is the one that I've been focused on. It bottomed at 17. I've been thinking it might be worthwhile to accumulate between 17 and 20, but I also told you it's got to clear 21, 25 to become a big investment. So you see the 52-week high? That if that gets taken out, then it opens the door for a much more substantial ride. Let's look at it on a 10-year basis. Changing your chart number can help you get better perspective. You're fishing around this thing. It used to be way up above 60 in this last decade. It used to be above 30 not all that long ago. In fact, the last time the stock market had big trouble, which was early 2016, look what this thing did. So I think this thing is trying to creep up. And if it gets above the 23, 25 area, 30 looks like it could be in the cards with an outside chance of 40. For part of a portfolio, it might not be that bad of a deal because the popularity of this investment is very, very low, which means participation is probably very low, which means there could be a lot more people to come into the party. With Amazon at 2050, with Apple at 225, everyone is at the party, which means the most likely thing is people exiting the party. And that's, again, just a little conceptual thing to think mentally. If everybody's into something, again, you could run out of buyers, or if the selling were to start, there's not a lot of liquidity on that side of the market. If people started to wanting to buy this thing and there was a good reason to buy it, who's going to sell it at the lowest price it's been at in 10 years, right? Right. So anyway, just to keep an eye on that. It's a sector that people aren't talking about, and I think it's worthwhile to keep an eye on. Let's take people are wondering, where could you have hit out and done okay in the last couple of 3 months? Well, a couple of them were REITs. So let me show you NLY, which is one that I follow. It's called Annaly. And you can see that in the last 3 months, or 2 months anyway, where the market was tanking. Let me go back here and go to the 1-year graph. get back to the 1 year graph so you can see here. 1 year. Okay. And it pays 12% yield, which is a heck of a yield, P ratio of 3.9. And you can see how it's been doing in the last few months. It has been hanging in there between what? Let me get it back down for you. It's been hanging in there between 950 and 10. It's at 994, and it's paying a heck of a yield. If you wanted to look at a REIT, a ETF, Vanguard has one, VNQ, and that'll give you an idea, what that's been doing. And this is a diversified, obviously REIT. You're looking at 5%. Excuse me. You're looking at 5%, and you're looking at a market that had come down, but it has been somewhat stable down here around 76, right? But it has come down. Annaly actually has been more stable. The other one people have been hiding out is in utilities, and let's see what that's been doing. That's been coming off lately, but over the last few months, it's been fairly stable. So let's take a look at that. It's paying 334 on this particular ETF. There's many of these. I'm just showing one as an example. And as you can see, October, November, December, this thing has been between 120, 125, and it's been paying 334. So it's been pretty stable. So REITs and the utilities has not been a bad place to hide out during this period and get good income or cash flow off of the dividends. Okay, let's look at some other ones out there because I'm sure you're into a lot of different things here. Let's look at your energy. I'm going to look at some ETFs from Vanguard. There you go, in the tank, big. And again, what makes this interesting to me, I'll show you in a second. I believe moving average price and time, not people's opinions. People lie, moving averages. At any rate, you're looking at getting 352 yield according to the screen here. That's not too shabby. You're being priced at 75.60, which is the 52-week low. You want to get bearish on energy? 109 is the 52-week high. You want to get bearish at 75? Might be a little late. Now let's see how far underneath its moving averages it is. Because if it's 20% or more, it's time to start looking at the long side, in my view. Yeah. So you're at almost 100 on the 200-day average, right? That's your 200-day moving average. It's inverted, so you're a downtrend, but the volume has been huge in the last 50 days, which means everyone's getting out, and you're now 25% underneath the 200-day average. So not today while it's making new 52-week lows, but I would be looking for chart formation, like a weekly low surrounded by higher weekly lows that would give me an indication that the selling is abating. And if I get a significant situation like that, this would start being very interesting. But I'd like a chart formation before I stick my head into a buzzsaw, because obviously people are getting out of this thing like somebody yelled out fire. But of course, that's when people have a fire sale, right? So anyway, there's the ETF for the energy. And next one here is healthcare. That was the place people were hiding out, but they started to nail that lately as well. Let's take a look at the healthcare. You can see that was no place to hide out, right? 180 down to but again, you're getting into a bit of an oversold category, and look at that selling, that volume way up there. So you're looking at some heavy volume, some very discounted prices. And so, again, healthcare is certainly not a situation where, there's price inflation in healthcare. There was I think a 4.8% annualized healthcare increase in the last report. So that was a significant increase in healthcare costs, which should go into the drug companies like Pfizer, Merck, et cetera, Bristol Myers Squibb, and should also help United Healthcare and other people like that. So you got a lot of different people there, and that has been whacked hard, and that would be a neighborhood to also keep an eye on as well. It's Christmas time, right? And so maybe the Federal Reserve is actually masquerading as Santa, because what they've done here is given you discounted prices on some very high quality companies. And so maybe it's time to take advantage of Santa sometime in the next few weeks or month or whatever. All right. Next one here is going to be consumer discretionary. They were doing great as well. Here's an ETF on that. and I'm sure they've got whacked. And again, the consumer is still very much employed. So this is something to keep an eye on as well. I mean, it's down here and making new 52-week lows at 143 and be up at 180. I'm sure the moving averages will indicate that you're getting a good 20% underneath the moving average. 144, 167. That gives me what, about 25? So 25 divided into 167. Yeah, I'm at 14, 15% underneath the moving average. Not extended tremendously, but certainly a little bit. Everyone's talking about Nike today, so let's give you a little Nike update here. Bouncing around. You have a specific situation you want to talk about, I'm more than happy to give you my input. Again, you have to make your own decision. You have to make your own choices with your clearing firm. But if you wanted to use my information for informational purposes only, I'm certainly more than happy to help. OptionProfessor@gmail.com. Nike was up to 74.29. It's already lost a lot of the gain. And of course, Nike's problems is just like everybody else. The market's in a downtrend. So let's look at where the moving averages are and see what the story is on Nike. The fact that it's above 70, I think, is very good. If it cannot hold above 70, that is very bad. So here you go. You're inverted at 72 and 74. Is there a reason why it stopped at 74? Well, how about your 200-day averages right there? So if this thing starts trading back under 70, I'd get the raincoat back out because it looks like it could go and start raining on you again. But it did have a good earnings report. The PE ratio is up at 57, though. So you want to know what the trouble is with Nike? The valuation is not cheap, right? Right. So not only do you have to have the right name, but you have to have the right valuation. Let's look at the financials because everyone's getting bearish on those. Let's look at like Citigroup, okay? Citigroup and some of the other ones that are international are getting whacked very hard, but they are getting into a situation where they're getting way off their 52-week highs. Look at the 52-week high, $80 on Citigroup. Where's it at now? 50. Okay, so again, look at a volume. They're coming out huge. Okay, so I would be looking down here for some type of capitulation where I see a low surrounded by higher lows, and then I might be thinking that the selling might be done. Obviously, the inversion of the yield curve is concerning to people because why? Because they have to pay out depositors and they're lending long. And if you're lending long at less than you're paying out your depositors, it's hard to make money. And that's why the inversion of the yield curve is whacking the banks pretty good. And people were touting these banks, every guy on TV, touting and touting and touting. And it just was the worst advice you'd ever find. The thing's gone from 80 to 50, and some of these people still won't give up their blankie, meaning they still won't give up their opinion that the banks are the place to be. I don't know if they get quotes or not. Looking at that, how could you possibly be telling people, that it's been a great investment? At best, you might be able to step in here and find some value at a very discounted level. The tech sector, Microsoft is one everybody owns, seems like. Let's take a look at some of the big guys and see what's going on, and then I got to sign off. Okay, Microsoft, 99. Where is it at as far as, see, the P ratio is 41. It's a high P ratio. It's a tough racket. We're normalizing interest rates, which means we're probably going to normalize PEs, which means we're going to normalize the growth in stock. So again, some of these companies with the high PEs are vulnerable, and this is one of them. Now, obviously, we're getting underneath 100. Can you see that's not a good place to be? So careful that Microsoft could accelerate to the downside. How can you do something? There are hedging tactics like collars and hedging tactics like married puts. They have a use and they have a risk. Don't even think of using them until you understand the use and risk. And if you need help on that, again, you can let me know. All right. Another one that everybody seems to own there is Apple. We already went over that. It's trying to hit the 150 area. If it blows through that, then you've got more downside to come. With regards to Amazon, that was something that I was telling people on this broadcast, that if you're up in the 2050 area and your moving average is at 1500, you're going to roll over, and you better have some hedge on, or else you're going to lose a lot of money. Can you see we had the double top up there at 2050? Let me get a better screen up for you. Top, you took out 1900. That was it. You got to hedge yourself from time to time. Again, another thing to consider, if you can't take the heat in the kitchen right now, you think there could be big more to go, you could consider using long-term equity options like leaps to replace stock positions. That gives you a position while we're down here, and it also gives you limited risk when you go to bed. That could be very comforting to certain people. So again, long-term equity options replacing stock positions to reduce cash risk is a consideration to some. If you don't understand what I say, OptionProfessor@gmail.com. And again, for those of you who come regularly, it is good to talk to you. I wish you a Merry Christmas and a Happy New Year. And also, I encourage you to let friends and associates know that the podcast is available and so that they could take advantage of it. Again, we went over quite a bit here today. And again, we will be off next week, and we will be coming back right after the first of the year. Again, for stocks, look for the 24 area, plus or minus a little bit, to be an area where it could have a capitulation. And again, once it does, look for a low surrounded by higher lows to give you an indication that the selling has abated. Right now, we're making new 52-week lows in many things, so it's too early to make that statement. But we are getting very far away from the moving averages, and historically, that has told me that we should be looking for a place to enter, not exit, and not for a bull market, but for a very substantial bounce. Okay. All right. It's very good to be with you again. I'm Jim Kinney. And again, this is the weekly update for the OptionProfessor.com. Good holiday to everyone. And again, we'll be back with you right after the first of the year. Be safe and enjoy your holiday time.